In the aftermath of the Russian financial crisis, Mrs. Watanabe and others involved in the carry trade were left licking their wounds. Meanwhile, back in Japan, the government was dealing with its own economic challenges. Even after being the world's first country to introduce a zero-interest rate policy in April 1999, Japan was still facing a new monster: deflation. Deflation is when the overall level of prices in an economy decreases, incentivizing people not to spend their money by delaying their purchases because they expect prices to fall further. In response to this, in 2001, the Bank of Japan decided to take another bold step to fight this deflation. It became the first country ever to introduce a policy known as quantitative easing, or QE for short. This practice has since been adopted by other central banks worldwide, particularly during the 2008 financial crisis, and more recently during the pandemic. In simple terms, QE is when a central bank, like the Bank of Japan, creates new money and uses it to buy government bonds, or a title where the government promises to pay back the borrowed money at a certain time and with a certain interest rate that are both fixed during the creation of the bond. This floods the economy with money, lowers interest rates even further, and encourages people and businesses to borrow and spend. It's like adding fuel to a fire to make it burn brighter. For Mrs. Watanabe, this was a double-edged sword. On one hand, the even lower interest rates in Japan meant that the potential profits from the carry trade were higher, and on the other hand, the risks associated with the carry trade were still fresh in her mind. The introduction of quantitative easing was a defining moment in Japan's economic history. It represented a significant shift in the Bank of Japan's approach to managing the economy. And for our Mrs. Watanabe, it was yet another twist in her financial journey. As we enter the new millennium, Japan is still working hard to fix its economic problems. Yet, even with all the risks, the carry trade was still attractive to many Japanese retail investors. The potential for more profits is too hard to ignore, especially now that the yen is cheaper to borrow, thanks to the Bank of Japan's quantitative easing policy. Around 2005, a significant number of Japanese housewives ventured into online currency trading, and the term Mrs. Watanabe started to become really popular around the world. The typical Mrs. Watanabe was in her mid-30s, computer-savvy, known in Japan as clickety-clicks, and often traded foreign exchange markets using her own money, family savings, or borrowed cash via margin accounts. Many of them began with forex trading because the transactions were easy for a beginner investor to understand. At that time, the media was filled with stories about the so-called real housewives of Japan. The New York Times interviewed a number of middle-class Japanese homemakers who moonlight as amateur currency speculators. In their 2007 story, the Times went on to explain, tens of thousands of married Japanese women ventured into online currency trading in the last year and a half, playing the markets between household chores or after tucking the children into bed. While the overwhelmingly male world of traders and investors here mocked them as kimono-clad Mrs. Watanabes, these women collectively emerged as a powerful force, using Japan's vast wealth to sway prices and confound economists, to the point where their carry trade strategy caught the attention of way bigger fish. Hedge funds and banks entered the game when they understood the process, borrowing from countries with low exchange rates and investing in countries with high exchange rates, especially the Australian and US dollar. This strategy has remained profitable despite academic literature that should have arbitrated away this free lunch. As time went by, many new actors entered the market, so many in fact, that it started to get global attention. The attention was not all positive though. Some financial experts warned of the risks the Mrs. Watanabes were taking. They worried about what would happen if another financial crisis caused a rapid unwinding of carry trades, just like what happened during the Russian financial crisis. For that reason, in 2006, the Bank of Japan voted the end of quantitative easing and began to move away from its zero interest rate policy, increasing interest rates slowly. This shift reduces the appeal of the yen carry trade, as the cost of borrowing in yen would increase. The goal was to make the yen rise and the carry trade less attractive and riskier. A rising yen would make it more expensive to pay back these loans at the same time that the yield differential or potential profit would narrow if Japanese rates rise. Which lead Dennis Gartman, editor and publisher of the Gartman Letter, a Virginia-based investment advisory service at that time, to say, the unwinding of such enormous positions shall either be done slowly and over a great deal of time and likely in tears, or it shall be done swiftly, massively, and accompanied not only by tears, but also by a great deal of pain. For now, however, Mrs. Watanabe was enjoying her moment in the spotlight. Her story was an example of how ordinary people, using their savings and a bit of risk-taking, could make waves in the global financial market. But as they would soon find out, a huge financial storm way bigger than anything they've experienced so far was starting to form on the horizon.
Two 2008 was a tumultuous year for the economy.
What the heck is going on down here? I don't know.
Many economists now believe this downturn will be the most severe since the recession of the early 1980s.
The 2008 financial crisis was bigger than anything Mrs. Watanabe had faced before. The crisis started in the United States with the collapse of Lehman Brothers, a massive investment bank. As this giant investment bank crumbled, global financial markets spiraled down, sinking many economies across the globe into a deep recession. Just like during the Russian financial crisis, worldwide investors shaken by the turmoil scrambled for safety. They pulled their money out of risky investments and rushed to buy safer assets, including, you guessed it, the familiar Japanese yen. Again, as demand for the yen rose, its value shot up too. For Mrs. Watanabe, this was a case of déjà vu. The rising yen meant paying back her borrowed yen for carry trades would cost her more. In the face of this reality, carry trades started to unravel rapidly. The Mrs. Watanabes, in a state of panic, rushed to escape their positions. And it wasn't just Mrs. Watanabe. Thousands of retail investors across Japan, who had once enjoyed the profits of the carry trade, found themselves facing significant losses. The magic money-making machine had turned into a nightmare. Many amateur traders suffered huge and sudden losses, as they learned that while the transactions may be simple, the global macroeconomic forces affecting foreign exchange markets are the complete opposite. One woman, interviewed by The Times, lost nearly $100,000, her family's entire savings, in just 1 week. The 2008 global financial crisis was a brutal wake-up call about the risks tied to the carry trade. It served as a sobering experience for Mrs. Watanabe and her fellow traders, making their time in the global spotlight feel like a distant past. The crisis also marked a turning point. It was the moment when the world truly realized how interconnected our global financial system is, and how quickly a crisis in one country can spread to others.